More great news for mortgage rates with the CPI report. This is the weekly report on Major Money Matters. Welcome to Major Money Matters. My name is Major, and this is where we look at economic news and how it's affecting your home buying or your home selling process. And this week we got some great news, but before we get to that, let's look at the charts. And if you follow this channel, you know we want this chart to head upwards because as the price of mortgage-backed securities increase, interest rates go lower. So we see some downward trend here starting off January. And this is exciting news, which is helped by the CPI numbers, which we'll get into in a little bit. But let's flip over to the actual mortgage rates and how this corresponds. So we're seeing a little above 6%, so a little bit better than we were on last week, about 0.25% better. This, by the way, is not a quote. This is just average mortgage rates with 20% down. You see FHA, VA, all those numbers under 6%. We're heading in the right direction. Of course, if you're doing a 2-1 buy down, you can have an interest rate that's in the mid, possibly even based on the day, the low threes for the next 12 months if your realtor is able to negotiate a 2-1 buy down for you. So very, very good trend that we're seeing in mortgage rates right now. Mortgage rates were helped this week by the CPI number. That's the Consumer Price Index. Now, the Consumer Price Index measures the cost of goods and services to consumers. So CPI numbers come out and shows that inflation currently is at 6.5% year over year. Now, that sounds like a bad number, but actually that's a good number because the rate of the increase is actually coming down. Last month we were at 7.1, now we're at 6.5, and we're headed in the right direction. But there's still some goods and services that are still costing consumers a lot of money. At the top of that list is eggs. Eggs, the price of eggs is up nearly 60% year over year. So if you're planning an Easter egg hunt, probably would cancel it or switch to those plastic eggs with the chocolate in the middle, put some Hershey Kisses in there. Those are better anyway. So cut out the eggs. It's getting more and more expensive because of the avian bird flu that's affecting chickens right now. So eggs are getting more and more expensive, although the rate of inflation is coming down. Next up, we take a look at comments from the IMF. The IMF is the International Monetary Fund. Now, this is not just looking at the US economy, looking at the world economy on a global scale. The head of the IMF says that 1/3 of the world is lurching towards a recession. Now, we've been talking about this and the way this impacts mortgage rates because we know in a recession, mortgage rates tend to go down. So they're saying 1/3 of the world is going towards a recession, and people are saying, well, we're not in a recession right now. Things are looking pretty good right now. The reason that things are looking pretty good right now is because Americans are piling up credit card debt. And I'm seeing this as I'm doing pre-approvals. More and more people are adding credit card debt because their income wages are not keeping up with the rate of inflation. People still have to buy goods and services. So what's happening is people's credit card debt is continuing to go up, but that is going to come to a head eventually. And then you're going to see really the impacts of a global recession, which means lower mortgage rates. Finally, we end with this. I get a lot of questions about why I believe that mortgage rates will come down faster than they went up and how we could see a refi boom in the summer. For those people that bought at 6% and 7%, could get an opportunity to do a good refinance in the summertime. And here's why. So the 10-year Treasury currently is at 3.5%. During the height of inflation, we saw interest rates at 7.5%, when the 10-year Treasury is at 4.5%. So companies built in another 3%, when actually, if you look at the historical average of 30-year rates versus the 10-year Treasury spread, usually it's about 200 basis points or 2%. It was 3% built in during the height of inflation. So we are going to see that come down. Right now, mortgage rates are about 2.5 higher. So there's a lot of play in there to get mortgage rates back to the normal 2% spread. So if the 10-year Treasury goes down to 3%, you could see mortgage rates at about 5%. Finally, as we wrap up, I'll tell you this. I'm seeing a lot of people come back into the market. People who decided last year to wait, people who decided last year to go rent for a year. Now they're coming back. We're doing a lot more pre-approvals, a lot more people going under contract, using 2-1 buy downs and stuff like that. I'm telling you, if you are a buyer, you could be in a small window because we still don't have enough inventory. When these rates get down to potentially 5% and you have government rates in the 4s, then you're gonna see a lot of buyers buying and you're gonna see a lot of traffic, which is gonna put upward pressure on prices and drive prices back up. That could be about 3 to 4 months away, okay? So keep that in mind. That's all for this week. See you next week on the Weekly Report.